Good evening, everybody. In today's video, I want to cover a very specific type of play. The play is called selling a covered call option. This play is absolutely fantastic for somebody that already owns shares of specific stock, that already had a run-up in the price of that stock, and is very happy that if they had to sell, they're very content with the amount of gains they already made on that specific stock. Also, it is a fantastic option for anybody that thinks they might have missed the boat getting into a certain play and wanted to buy stocks. By buying the certain stock and then writing a covered call option on that specific stock, you get a premium that's collected, which means that you reduce your overall cost of that specific stock. There is no downside in this strategy as long as you are content with the amount of gains that you would be making if you were selling your stock at a certain price. If you've lost me already, don't worry. I will give you a specific example, and then I will actually show you a play that I'm going to be doing this specific week. A lot of people are worried to get into a stock like a SoFi or a Palantir, and an equal number amount of people already have a lot of shares of Palantir or SoFi or whatever other stock, and they want to leverage those stocks, essentially making a fake dividend play. By selling these covered call options, you can make a nice premium, and that premium is collected for the duration of your contracts. Now, you can do a contract for a week, a month, a year, so on and so forth. Whatever's good for you is good for you. You could also sell these way out of the money. For example, if you have a share of Palantir that right now is trading at around $16.50, you could do a 1 week call option and you could sell if the price of Palantir hits $19 a share, for example. And the question is, do you think that the price of Palantir is going to go up 20% over the course of the week or not? Now, the premium you would be collecting is very small. However, it's pretty secure that Palantir will not hit $19 by the end of this week because that is a huge, huge run up. Not saying it won't, but the chances are that it will not. Also, since Palantir had a crazy run-up and since SoFi had a crazy run-up, you kind of are collecting a lot of premium because you don't think that the stock is going to run so hot. It's not going to hit such a percentage. Don't worry about it. If everything I'm saying is really still confusing, I'm going to give you some examples and you guys are going to understand it a little bit better. I truly wanted to give everybody an options play for this week, and I promised you that this video was going to come out today. And I don't want to go back on my promises. And that's why at 11 o'clock at night, I am making this video for my beloved channel members. Thank you so much, and I appreciate all of you guys. Before we go any further, let's just explain exactly what a call is, shall we? A call option gives a buyer the right, but not the obligation, to buy a stock, or for this case, any other asset, at a specific price and specific time duration. Now, the specific price is called the strike price. Now, a covered call option consists of two plays. Owning the underlying stock, and you would have to own 100 shares of the underlying stock. 100 shares is the equivalent to one option contract. If you have 1,000 shares, that is 10 option contracts. If you have 1,050 shares, it's still only 10. You need an even number. 1,000, 1,100, 1,200, 500, 400, 300. Every 100 is one contract. And the second piece to the equation of selling a covered call is you're selling or writing the option on the specific stock that you own 100 shares or more of. Let's use an example. Say you own 100 shares of XYZ stock. The current trading price is $50 a share. You believe that in the future the price is going to rise, but the price is going to rise moderately. It's not going to absolutely moon and skyrocket. And you believe that it's not going to moon or skyrocket, let's say, over the course of a month. And remember, you can adjust this to a week, even several days if you're buying it or if you're selling it in the middle of the week, Or you can adjust this for 2, 3, 4 months, a year, whatever. Let's just use the example of $50 a share, 1 month duration. And now you want to make a premium. You want to make money on your shares. So you can say, hey, I want to write a contract for a $55 strike price, and now you're going to collect a premium. Whatever that premium is, I don't know what it's going to be, but I will give you a specific example. So now you're selling an options play for your shares that are currently trading at $50, and you believe that in the future, the price will not hit $55. But if it does hit $55, you will sell your shares at that $55 strike price. Mind you, this entire time you're collecting a premium. Let's say for argument's sake, the premium that you will be collecting on your shares would be $200. Now let's say at the time of duration, at the end of the month, at 4 o'clock at the end of the month, the last day of the duration that you set up for your call option, the shares of that stock is not $55. It is lower than $55. There is no execution, and you get to keep your $200 premium. Again, that $200 is an arbitrary number, but I will be showing you specific numbers in just a moment. No harm, no foul. You keep your premium, and it is a nice payout on the stock's hold. Now let's say that the price of that stock actually hits $55 by 4 o'clock at the end of the month. You are obligated to sell your 100 shares of stock for $55 each. And you keep that premium, which in this case, let's say is $200. So let's say you have stocks and you don't mind making, in this case, 10% on your money. You bought them for 50, or you already have them at 50 and you want to sell them for 55, which means you're collecting a 10% increase in the price of your shares plus the premium. The downside here is, let's say the price of shares goes to $60 or $58 or $100. You still have to sell your shares for $55 a share, because that is the contract that you set up as the seller with somebody that is the buyer. This is a very good tactic. Again, if you already have shares and you're massively up and you don't mind selling your shares. But if you sell your shares, you will have a tax burden. Please keep that in mind. The more out of the money you sell your shares, the less premium you will be collecting. In my case, I wouldn't sell $50 stocks at 55 strike price for a month. I would probably sell a $50 stock at around a $60 strike price for a 1 week duration. And I would probably be collecting a very small premium. However, it is what it is. I rather collect a small premium, but make sure that I don't sell my stocks. But if I was getting into a stock right now, if I was opening up a position, for example, you're not in Palantir, you're not in SoFi. You want to buy Palantir, you want to buy SoFi. Why not buy 100 shares or whatever, how many shares you want to buy, and then put a strike price of whatever percentage you wanted to make? Let me show you guys an example. Last week, I ended up making this play. I ended up collecting a $330 premium. This is the money that I collected. This is my money for putting these contracts out. I ended up doing 33 contracts at 10 cents each. Remember, it's 10 cents times each share, and every contract is 100 shares. So 33 contracts is 3,300 shares times 10 cents, which is $330. That's what I collected. I started this play on 6/13. I ended up doing the duration until 6/16. So it's 4 days, the 13th, the 14th, the 15th, and the 16th at the end of closing. At the time of making this play, the shares of Palantir was trading at around 16 and change per share. I ended up doing a call option for $18.50. The reason why I did $18.50, it was approximately 20% above the actual price of Palantir at the time that I opened up this contract. And at the time of the expiration of the contract, the price of last week closing for Palantir was like $16.80 or something. So I didn't have to do anything and I collected my $330. Let me show you one of the options plays that I'm going to be doing for Palantir this actual week. All right, now I'm in Palantir. On the right-hand side, click on Trade Options. Over here, you can do the duration, but before you do that, instead of buy, make sure you press sell. The duration can be whatever you want. Like I said, 4 days, 11 days, 18 days. It can go all the way out to 2 years almost. I like 4 days. The current price is $16.23. I will add 20% on top, which is around $3.20 and change, which brings me to a number of $19 to $19.50. On the left-hand side is going to be the strike prices. If you go up a little bit, I want to do either the $19 or the $19.50. At $19, I will be collecting a 10 cents premium per share. At $19.50, I will be collecting an 8-cent premium per share. Let me show you how it works. Let's say I click this, and then I would press continue. When you press continue, it's automatically going to take you a penny less. This is just the way Robinhood is. Change that to 0.10, okay? So if I'm selling one contract, which is 100 shares, at 10 cents a share, I would be making $10 per contract. And then you click review order, and then it will tell you, you are agreeing to sell 100 shares of Palantir at $19 on or before June 23rd. If you aren't asked to sell by then, you'll keep your collateral and full $10 of credit. Now, if you go right here, you'll notice you're doing a $19 strike. The break even is $19.10. Why? You have to sell at $19, but you're still collecting a 10-cent premium, which means as long as the price does not go above $19.10 by the end of this expiration date, whatever it is, you're good, you Gucci, you break even. Of course, there's a bunch of tax implications, especially if you're trading for short term, which is less than 1 year. You're going to be taxed on your personal tax bracket. No long-term tax loopholes. Long-term taxes is 15% on the federal level for most people, depending on how much you're selling, but for most people, they fall under this category. This is a fantastic technique if you have shares, you're not too greedy, you're willing to collect a small premium, and you just want to make a dividend-like return on your specific investment. Or there's another way of playing this. Let's say you want to get into a position. Let's say you don't own SoFi, but you want to buy SoFi, okay? Right now, the price of SoFi is $8.50. You got to ask yourself, at what point am I willing to sell SoFi? Remember, you're not in SoFi right now. You want to make a certain percentage on your money. You can tell yourself, hey, I am willing to get SoFi and I am willing to stick with SoFi until it reaches the $10 mark. If SoFi reaches $10, I'm willing to sell it because I made my percentage, I made my returns on my investment. If you are happy with that, you might as well put a contract to sell a covered call. Let's say right here, you would buy 100 shares, okay? 100 shares of SoFi, 100 times 850 would be $850. But if you trade SoFi options and you go to sell a call, you do a 4-day or you can do an 11-day. So between a 4 and 11, and the more days you go up, the more premium you will collect. But right here, you could do a strike price of $10, which means you would be getting a 9-cent premium. So you would actually buy your shares of SoFi not for $8.50, but you would be buying them for $8.41. Why? You buy for $8.50, but you deduct the 9-cent premium that you will be getting for selling a covered call. Now, if you do the duration instead of 4 days and you now do 11 days for the same exact thing, you would now be getting 25 cents per share. But let's say you want to do 32 days, a month. You would now be collecting a premium of 36 cents per share. This technique of selling covered calls, again, the downside is the price skyrockets and you have to sell it at a smaller amount. However, if you're okay with selling shares at a certain price because you already made your money, right? Some people are up 50%, 100%, 20%, 30%. Some people are happy making 10% return. This is a fabulous way of increasing your profits by lowering your entry point. You can also sell them every single week. Eventually, you will make a very nice return on your investment. If I were to sell covered call options on my Palantir shares, I have 100 contracts to sell in this specific account. I would be making approximately $1,000 every single week. If you take that into account, I will be making around $52,000, but let's just call it $50,000 for the year. If I have 10,000 shares of Palantir, that is equivalent to around $160,000. Now, if I'm making my $52,000 on $162,000, I will be making approximately an additional 33% on my money for the year. But remember, this increases as you have an increase of price. You start collecting a bigger premium. The best time to buy a covered call option is actually on a green day. For example, if Tuesday comes and it's a red day, you might want to wait for Wednesday to buy, or you might want to wait until the end of the day and wait for a green day. It's also okay to skip a week. You don't have to make this options play. Don't rush into anything. At the end of the day, if you play this right and you're not greedy and you're selling really out of the money, or you're a very dedicated investor and you know how much profit you want to make on every single play, then this is a fantastic method in order to get extra returns on your investment. I ended up selling my covered calls last week for Palantir. I will be selling covered calls this week for Palantir. I will be happy to go 20% out of the money because chances are Palantir is not going to have a 20% week, especially right now when Palantir is up over 150% year to date. You understand my logic behind this? And if I happen to sell my Palantir at $19 or $19.50 a share, I wouldn't be crying either. I would end up buying back into Palantir. Since I held these shares for over a year, it's all good. It is what it is. You take a little bit of risk, but again, it is what it is. And if you are not greedy and you sell out of the money, or you're already getting into a brand new position and you want to get in at a lower entry point, then this is a fantastic, fantastic play for you. As always, I am not a financial advisor, nor am I qualified to be a financial advisor, nor would I ever want to give you financial advice. This is purely for entertainment and educational purposes only. I am sharing my personal plays as entertainment and education. This is not for you to mimic, and this is only for you to do your own due diligence and do your own research about your own plays. You are a grown woman and man, and your plays are your plays at the end of the day. If you make money, you make money. And if you lose money, you lose money. I wish you guys a happy, great day. Thank you so much for being channel members. From the bottom of my heart, I am trying to learn some more technical analysis right now. The more I learn about technical analysis, the more I'll be able to contribute to channel membership and do my own charting and technical analysis, right or wrong, make money or not make money. Again, entertainment and educational purposes only. If you guys have any questions, please feel free to ask me. I don't know if I explained it right or if I got my point across. I think I did, but I will also be showing you an example when I actually do sell my covered calls. I'm not sure if I'm going to be doing it tomorrow. I might do it on Wednesday because tomorrow is going to be an absolute packed day for me. Thank you very much and enjoy the rest of your evening.